Welcome to the deep dive. We sift through the dense stuff, press releases, investor decks, the raw data, and we basically give you the shortcut.
Mm-hmm.
Today, we're diving into Yes Bank's Q1 FY26 results. That's for the quarter ending June 30th, 2025.
Yeah, and this is, well, it feels like a pretty pivotal moment for them. Our job today is really to get past just the numbers on the page.
Right.
We want to pull out the key insights. How stable are they? What are the strategic shifts telling us? And crucially, how real is this turnaround? We're looking for the context behind the figures, especially now, 5 years after the reconstruction.
Okay. And I think the headline, well, it's practically shouting at us from page one, isn't it?
It is.
If you've been following this story, the big takeaway has to be the profit consistency. Net profit after tax, PAT, came in at 801 crores.
Which is a solid number.
It is, but more importantly, it marks the seventh straight quarter of improvement in PATI. 7 quarters.
And that consistency, in banking, especially after instability, that's everything. It validates their strategy.
Yeah.
We're talking, 59.4% growth year on year? Huge. And 8.5% even quarter on quarter.
Mm-hmm.
It suggests this isn't just like a one-time gain from something volatile. It feels like stabilization turning into, normalization.
Okay, let's unpack that momentum then. Segment 1, profitability and efficiency. You mentioned the core engine running smoother.
Exactly. Look at the operating profit. That's up for the fourth quarter in a row. Hit 1,358 crores.
Which is up 53.4% year on year. Quite a jump.
It really is, and it shows the PAT growth isn't just fancy accounting, right? It's coming from the bank's basic ability to make money before provisions and taxes.
And that operational strength, it feeds into better efficiency metrics.
Directly, yeah. Take return on assets, ROA.
Okay.
That improved to 0.8% this quarter. Now put that in perspective. Same time last year, 0.5% last quarter, all 0.7%.
So definite upward trend.
Definitely. In banking, you're always sort of reaching for that 1% ROA benchmark, moving from 0.5% to 0.8% in just a year. That's a strong signal they're squeezing more return from their assets.
And the other side of that coin, the cost-income ratio. That one really stood out to me.
Yeah. That tells you how much they spend just to run the shop, basically.
And it improved dramatically,
Yeah.
down to 67.1%. It was, 74.3% a year ago?
That's a huge drop. Significant improvement.
What's driving that? Is it cost control, income growth, or?
It's likely a bit of both. We'll touch on the digital side later. That helps costs. But fundamentally, they're either making money faster or spending less to do it.
Right.
And this quarter, the sources specifically point to a big boost on the income side, non-interest income.
Okay, yeah, that number jumped out. Up 46.1% year on year. That's massive. But the footnote.
The footnote, yes. Aided by treasury income.
So income from market activities, bond trading, that sort of thing.
Exactly. Now, it's great management that they captured that gain, no doubt. But the fact that it provided such a lift makes you wonder, how much is coming from the core predictable fee income from transactions, cards, wealth management fees? Is that growing as fast?
Right. It's a key thing to watch. Can they keep non-interest income high without relying so much on potentially volatile treasury gains?
Precisely. It's a good result, but sustainability is the question.
Okay. What about the core lending side? Net interest margin, NM?
NM was flat quarter on quarter, 2.5%.
Sad.
But importantly, it is still trending up year on year by 10 basis points. And in this environment, stable is pretty good.
What's helping keep it stable or even nudge it up year on year?
A big part of it is on the other side, their funding costs. The cost of deposits actually dropped.
Oh, interesting. By how much?
20 basis points, both year on year and quarter on quarter, down to 5.9%.
Okay, getting cheaper funding. That definitely helps the margin.
Absolutely. And that leads us nicely into segment 2, the balance sheet itself.
Right, the foundation. Their official strategy here is granularization. Can you unpack that?
Sure. It basically means shifting away from relying on big, potentially flighty wholesale deposits
Towards smaller, stickier retail customer accounts.
Exactly. Everyday people and small businesses. Total deposits grew 4.1% year on year, which is okay. But the quality of that growth is what matters.
And how do we measure that quality?
The key metric is CASA, current accounts and savings accounts. That's the really low-cost, stable money that customers park for daily use.
So more CASA means cheaper, more reliable funding. How's the CASA ratio looking?
Looking good. It improved 200 basis points year on year, now at 32.8%.
2 full percentage points. That's quite a shift.
It is. It shows that granularization strategy is really paying off, and you can see where it's working. Retail and branch banking deposits led the charge up a whopping 20% year on year.
Wow. And the sources even break down the retail cases specifically, right?
They do. Retail CASA is at 38.2%. So the average person engaging with Yes Bank, whether in branch or online, is bringing in that valuable, cheap funding.
So they're building a much stronger liability base, less volatile.
Structurally stronger, yes. Now, flip to the other side, assets, net advances, lending. That grew 5.0% year on year. Slower than deposits maybe, but they seem quite selective.
Where is the lending growth concentrated?
It's focused on areas that, frankly, offer better yields and diversification compared to the old days of large corporate concentration.
Makes sense.
Commercial banking, think mid-sized companies, that's up 19.0% year on year. And microbanking, very small businesses, up 11.2%.
So a clear pivot in the loan book mix.
Definitely. Those segments now make up about 3/4 of their total loans. It's a deliberate shift.
And critically, are they backing this growth with enough capital?
Seems so. The CET1 ratio, that's the core high-quality capital buffer, improved to 14.0%.
Up from 13.3% last year.
Right. So as they grow, they're also strengthening their safety net. It shows they have the capacity to absorb shocks and support future secure lending.
Okay, let's shift gears. Segment 3. All this talk of profit and growth is great, but it means nothing if the foundation is shaky. Asset quality. How are things looking there? Probably the most watched area for Yes Bank.
Well, the headline is stability, which in a growing loan book environment is actually a positive sign. The main ratios held steady quarter on quarter. Gross non-performing assets, GNPA, stayed flat at 1.6%. And net NPAs, NNPA, also flat at 0.3%.
Flat is good here. No deterioration.
Exactly. And what about the safety net against those NPAs? The provisions.
Right, the provision coverage ratio, PCR.
That's much, much stronger. It improved significantly to 80.2%.
80.2%. Wow. What was it before?
Last year, same quarter, 67.6%.
That's a massive jump in coverage.
It really is. Basically, for every 100 rupees of bad loans, they now have over 80 rupees set aside. It signals much higher confidence for management about absorbing potential losses.
Okay, now here's what I think is the real aha moment for anyone who remembers the reconstruction saga. The legacy issues, specifically restructured advances.
Ah, yes. This is huge. This tells us they're finally closing the chapter on the crisis period.
What's the number?
Restructured loans, those ones that needed special terms because the borrower was in trouble, now stand at just 378 crores.
Okay, but what does that mean as a percentage of their total loans?
That's the key part. It's only about 0.2% of their total advances. Tiny.
0.2%. Let's just pause on that. Remind us, what was that figure a year ago?
A year ago, Q1 FY25, it was around 1.6% of advances.
1.6 down to 0.2. That's an 8-fold reduction.
Pretty much. It's monumental. It means management can finally stop spending so much time and energy cleaning up the past. They can focus almost entirely on the future. The financial skeleton in the closet, it's basically gone.
And they didn't just wait for these to expire. They actively worked on them, right? Resolution momentum.
Absolutely. They recovered or upgraded a total of 11,170 crores worth of assets just in this quarter.
Impressive.
And importantly, that includes 338 crores specifically from security receipts, those instruments linked to the legacy bad loan pool. So yes, active resolution is happening, turning bad assets back into cash.
Okay, that leads us to segment 4. External validation and strategic shifts. Internal numbers look better, the legacy issues seem resolved, but is the outside world buying it?
Well, the endorsements are coming in, and they're pretty strong. In July 2025, just after the quarter ended, 3 big rating actions.
Okay.
Moody's upgraded their long-term rating to B2, stable outlook, and then domestically, CARE and ICRA both gave significant upgrades.
What did they move to?
Both moved the long-term rating up to AA, that's a AA-. CARE was at A, plus A, ICRA was at A. So that's a big jump for both, and again, stable outlooks.
AA-. Agencies don't hand those out easily. That signals real structural improvement, reduced risk profile in their eyes.
Exactly. Yeah. It's external validation of everything we've just discussed. But perhaps even more strategically significant than the ratings is the ownership change.
Yes, the SMBC deal.
This is arguably the biggest milestone since the reconstruction itself. The sources confirm a definitive agreement for Sumitomo Mitsui Banking Corporation, SMBC, a major Japanese and global bank,
right,
to acquire roughly a 20% stake in Yes Bank.
20%. That's substantial. And who are they buying from?
They're buying primarily from the consortium of banks, led by State Bank of India, SBI, that stepped in during the 2020 rescue. SBI, HDFC, ICICI, Axis, others.
So the rescue consortium is partially cashing out, and a global giant is stepping in. What's the significance of that?
It's huge validation again. 5 years ago, domestic institutions had to provide the stability. Now, a major international player sees the value and the long-term prospect enough to become the largest single shareholder.
Largest shareholder, so bigger than SBI.
Yes, SMBC is set to become the largest. Now, the sources clarify SBI will remain a major shareholder, which provides important continuity. But having SMBC take the lead role, that's a game changer. It signals global confidence, potentially brings in global expertise, technology, maybe even cheaper international funding down the line. It really marks the end of the reconstruction phase and the start of, well, normal institutional life, perhaps with enhanced global reach.
A very significant strategic shift indeed. Okay, finally, let's briefly hit segment 5, the digital engine. We talked about efficiency improving. Operationally, the push for digital must be driving a lot of that.
Oh, absolutely. It's the engine behind that falling cost-to-income ratio we saw. They are positioning themselves hard as a key player in digital India.
And the numbers back that up.
They do. Look at UPI payments, the dominant system here. Yes Bank is the #1 payee PSP, meaning receiving payments with over 55% market share.
Wow, majority share.
And their #2 is a payer PSP, sending payments with a third of the market share. They are deeply embedded in the country's digital transaction flow.
And it's not just payments, right? They're building out platforms.
Exactly. They launched the Iris Retail Super App, 150-plus features apparently, and an Iris Biz app for businesses with over 100 features.
So trying to be the main digital touch point for customers.
And it seems to be working. Bottom line, around 90% of all their customer transactions now happen via digital channels.
90%.
That level of automation is how you scale services without scaling physical costs proportionally. It directly feeds those efficiency gains.
Okay, so let's try and wrap this all up. If we distill this deep dive, the core narrative seems to be about consistent, focused execution. You could say maybe 4 key pillars.
That's about right.
First, sustained profit improvement. 7 quarters running, driven by better operations and ROA.
Pillar 1.
Second, the granularization strategy working, getting that cheaper, stable CLACA funding, especially from retail.
Pillar 2. Strong, low-cost funding base.
Yeah. Third, the balance sheet cleanup. Stable NPAs now, yes, but crucially, that massive reduction in the legacy restructured book. Feels like that chapter is closed.
Pillar 3. Legacy issues largely resolved. Clean slate.
And fourth, powerful external validation. Multiple rating upgrades to the AA level, and then the big one. SMBC coming in as the largest shareholder. Strategic commitment from a global player.
Pillar 4. External confidence and a new strategic anchor.
Exactly. So a fairly positive picture overall.
It seems so. And connecting all that, the improving ROA, showing stability, the definitive cleanup of the past, and now this major global bank stepping in, it really poses a final question for you, the listener, to think about.
Okay.
What does this combination, the major shareholding transition and the sustained credit rating upgrades, truly signal about the long-term institutional risk profile of Yes Bank, 5 years post-reconstruction? And maybe more fundamentally, how does having a partner like SMBC potentially change the bank's identity and trajectory from here on out?
Interesting question to ponder. Food for thought. Thank you for joining us on the Deep Dive.
See you next time.
We'll see you next time.